So, evening everybody, welcome to tonight's webinar on making tax digital for landlords, something I'm sure you're all very interested to hear about. So I'm Emma from Complete Estate Agents. So we've been holding these landlord surgery webinars open to all landlords, not just landlords of our own, and we'll be sending you out the recording of this webinar afterwards as well, so you can backtrack and go back through anything that Andrew said. So I'm going to start off by introducing you to Andrew Browne from Bishop Fleming. He's going to be talking to you about making tax digital and your tax liabilities. So Andrew, over to you if you'd like to introduce yourself properly.
Thank you, Emma. So I'm Andrew Browne. I head up the tax team at Bishop Fleming Accountants. Been doing tax for far too many years, about 30 odd. So in fact, I started, I think, when there were paper returns. So we've gone from paper returns to now the new MTD when it comes in, where everything will be electronic. So MTD, what does it really? Firstly, before I start, if you've got any questions, there's a chat box. Feel free to send questions as we go along. Very happy to answer those as they come up. Don't worry, any question is a good question. So feel free to ask anything you want.
In the chat box, I hope that should have come up for everybody to see where that is.
Yeah.
I'm sure.
Yeah, it's normally at the bottom, isn't it? So
bottom of the screen.
Good. So what is MTD? Well, basically, it means that you have to keep your records in a digital format. You have to send quarterly updates of income and expenses to HMRC, and then you do a final return at the end of the year, which is a bit like your self-assessment return. So the timetable, this keeps on actually delaying. I think it was originally coming in about 2018, but it is now coming in April 24. And I think this time it really will come in April 24. So you have at the moment about 18 months before it comes in. I think although it's not coming into April 24, it is probably something that you should start preparing for maybe early next year, getting used to having to use software if you don't use it, because you don't want to start in April 24. You have to do the returns when you haven't used this sort of information before. In April 24, people that have to do MTD will be sole traders and landlords where the combined income is over £10,000. So that means if, for example, you have 6,000 of income from your rental property and you had 5,000 from a sole trade, you'd be above the 10,000 and you'd have to do MTD. When you look at those limits, it is per individual. So if yourself and your spouse own a joint property and the rental income on that property is 12,000 between the two of you, so you have 50-50 each, then you wouldn't have to do MTD because your share would be 6,000 of the income. So April 24, if your income is over 10,000, you will be in this system. Partnerships come in April 25. So if you're in a property partnership, that might be a year later for the partnership element. Now, quarterly, so what you then have to do is do quarterly returns to the revenue in electronic format. And the quarter dates are 5th of July, 5th of October, 5th of January, and 5th of April. Those quarters you've basically got 1 month to file them. So your 5th of July return, you would have to file by the 5th of August. Now, they will let you do an election which says that you can run it to 31st of, say, March, 30th of April, rather than the 5th. I think a lot of people find that a lot easier, because if you're it's easier doing monthly returns probably than doing this 5th of April one, and the 5th of August, etc. So you will be able to do that. So you'll have to do 4 quarterly returns from April 24 and submit them to the revenue. Now, at the end, once you've got past the end of the tax year, you will then have to do what's called an end of period statement. This is basically like your self-assessment return, and that sort of mops up the whole year, does adjustments that you might not have done on your quarterly statements for disallowables or extra reliefs, includes your other income, and that has to go in the 31st of January, like your self-assessment return would used to have to go in. So that basically is like your self-assessment return. So you end up having to do 5 returns basically instead of the 1 now. Don't ask me why they're making you do this, but they are. So look forward to doing 5 tax returns instead of 1. The end of period statement will replace basically your tax return. So it will be probably a similar sort of return to what you're doing on your tax return. And that's the one that you sign to say it's complete and correct. So, you know, if you have made mistakes on the quarterly ones, there isn't anything, there shouldn't be a problem with that. Your final return, the end of period statement, is the one that you're signing like you sign your tax return to say you've declared everything. So that will be the most important return, and that's the one that you're putting your name to. There are some exemptions, but they're not very wide. So you can apply to be exempt from MTD. What the revenue have said, they would say you could apply due to age, disability, location, or if you're a practicing member of a religious society, that precludes you from using electronic communications or records. Now, if you want to apply from those exemptions, you have to actually apply, and the revenue have said they might not accept your request for an exemption. So moving to the real process when we get there, firstly, you have to check that your income's over this 10,000. So if it's over the 10,000, and the revenue will have said that they will check when they get the April 23 tax returns, and if your income is over that 10, they will send you a note to say you must MTD. If they don't, but your income's over 10, you still are obliged to register for it. Now you have to use software that is approved by the revenue. Now there is a list that they have started, and you can find that if you Google MTD HMRC approved software, it will come up with a list on the revenue website. There are a number of names that, if you know about accounting software, you see there, like Xero and Sage, and there's quite a few that are being developed. I think there'll be different levels that will come along. Some for the more complicated, like, which use like the Sage, but I imagine, and I can see there's quite a few that are being developed for like mobile phone apps, and where you can probably take a photo of the expense and it will do it quite cleverly for some of the small ones. So hopefully there will be some quite simple software there that you can use quite easily, and I expect that some will be, you can just use your smartphone and it will be able to do it. See a question already. Yeah, the 10,000 is gross income, so it's not your profit. So if you're renting out your property, you've got one property and renting out £1,000 a month, your total income is 12,000 for the year, you will be over it, even if your profit's, you know, £1,000. It is the gross income, not the net. So that's a good question, and hopefully, yes, you can see it's the worst one. It's the one for the total income, so a lot of people will be in it, no doubt. So the software one, I think if you're not using, I think quite a lot of people don't use software for if they've got one property or something, or 2 properties, and they might either use handwritten or Excel. They won't. You will have to use proper software under the system. So this is why I think it is worth probably in early 23 looking at the software applications that are around. A lot, I think, will be developed and approved by them, and maybe trying one for a year, because that will be probably the biggest change if you're not using software. The software should be good, so the software should actually allow you to complete these quarterly returns quite easily. What is meant to happen is when you have you put your income and expenditure into this software, and then it should do the quarterly returns automatically. So it should hopefully have a scenario where you've put in your income, you've put in your expenses, and you can press a button on the software and it will submit the quarterly return for you. That's the expectation of it. And I suspect, hopefully, there will be some good software out there that will do that. What we will do, and I'm sure others will look at the software, and we'll have certainly something on our website and as to which ones we recommend for different levels. And hopefully it'll be, I think some will be quite easy to use, hopefully. Yeah, the question there, again, that question on the 10,000 gross income, it's per person. So the question that has been said is, a husband, are both landlords, do we both get the 10,000? Yes, you do. You have to sort of apportion the turnover to your ownership. So property tax works on ownership. So if you own it 50-50, and then in that scenario, you won't hit the 10,000 level until the total income's got to 20. If it was like 60-40, it will be, one of you could go over, because one would have 12,000, one 8,000. So therefore, the one that's over 12,000 would have to do MTD, and the other one wouldn't. So depends on your ownership. Now, there's a good question there, and I was talking about quarterly returns. At the moment, they have said you're just recording the income and expenditure. So you wouldn't do your tax adjustments. The question is, do you need to do tax adjustments in the quarterly returns? No is the answer to that at the moment. These things can change, but I suspect that won't. So on the quarterly returns, you would be putting down income and expenses. When you do the end of year return, that's when you put things like capital allowances and other tax adjustments into it. So the expectation at the moment is any tax adjustments will be done in the final return, not the quarterlies. That does question why they want this information in the quarterlies, because it doesn't actually show what the tax liability is. But I think in answer to that, it's probably a stage, this MTD, that they're bringing in the MTD to get people used to doing it. It will give them valuable information, and it may be in future years that things change on that. When they first muted MTD, ourselves and quite a lot of the professional community in correspondence with the HMRC in consultation, there was some talk about them bringing forward the tax payments, so making people pay throughout the year. Now, they backed off on that. They said you could voluntarily do it, but I can't see many clients wanting to do that. In fact, they said, I'm sure most people will want to voluntarily pay up front. I don't think that, slightly naive. At the moment, though, you wouldn't have to do tax adjustments in those quarterly returns. Now, yeah, so that the subsequent question on that, and I think this is worth talking about because I assume income expenditures on an accruals basis. You have an option on property. So on property tax, you can either decide to do it on a cash basis or accruals basis. So those accruals means if you have expenses, perhaps you haven't paid yet, but you've had the invoice, you can accrue it. That means you can take a relief for it when you have sort of got the invoice or incurred the expenditure but haven't paid it. Cash basis is purely on when you pay it out. So it's a sort of choice for yourselves. Normally, I think in property businesses, particularly if they're residential properties, you tend to find that the income hopefully comes in quite regularly each month. So cash or accruals probably makes little difference in most people on that, unless you've got some bad debts. Expenditure, though, you might get the invoice and pay it out later. So if you're doing a cash basis, you probably could get relief at a later point if it goes over a tax year. I think it's probably a personal choice as to whether you think it's easier for you to record the information on a cash basis or accruals, because accruals is slightly more complicated. So there's probably a timing advantage on accruals. It's probably not that significant. So I think it's personal choice as to whether you decide you want to follow cash or accruals. You just have to tell them when you register whether you're going to do it on a cash basis or accruals basis, and you can't sort of swap every year. So you sort of decide at the start. Okay, so software choice is really important. I think trialing, I'm sure there are already quite a few coming out. They're not, they will develop further, I expect, and I think we'll get some quite clever ones, particularly with smartphones and iPads coming out in the next, hopefully 6 months or so. Most of them will allow you to trial them, so I would have a go at them and see which ones you like. Personally, I quite like things that you can have on your smartphone where you can just take a picture of the invoice and then say what it is and it goes into the system. I think that's great because then you tend to not forget to claim those expenses when you got the receipt. But I think that's down to personal choice. I would say try it out and see how it each bits of software suits you. Now, when you've got the software and when you get to April 24, you can register, and you have to register via the software. So they won't accept a registration unless you've got compatible software. That doesn't mean if you haven't got it, you don't have to register. It just means that you need to get the compatible software, otherwise they'll get upset with you. So you can do it, you can register for it via the software, or if you've got an agent, a tax agent, they can register for you. And you can, if you've got a tax agent, they can actually do your quarterly returns if you want them to, and they can actually record your information digitally. Now, there is a point with this on this digital bit. You have to keep these records digitally. They're not going to accept in the future paper records or other bits. So all of this is about moving everything to digital records. If you look at it, the whole point about this is it's much more easier for them longer term to check digital records than it is paper. It's their comment is it's much easier for the taxpayer. I think it's actually much easier for the revenue, to be fair, but they wouldn't admit to that. Now, tax payments, that's not going to change. So you still got your July payment and your January payment as you have now. So in the initial MTD, that does not change. You should still be paying your tax at the same time. As I said, who knows how long that will stay? Maybe longer term, they might move to a more some payments being paid in the quarterly. But at the moment, it will not change. The penalty system is going to change. So at the moment, if you don't submit your self-assessment return, you get a penalty. And that's just based on not submitting the return. Don't submit the return once, you get a penalty. The new system is going to follow a points system. So basically, every time you miss a deadline, you get 1 point. But points aren't good, they're bad in this case. Now, if you say, for example, if you missed 3 quarterly return deadlines, you would have 3 points. Now, for quarterly returns, you don't get a penalty till you get 4 points. So if you miss 4 returns, you will have 4 points. You will then get a penalty. And the penalties are at £200. That's for quarterly returns. For the final end of year return, it's only 2 points. So that one has a £200 penalty if you miss its filing deadline, which would be 31st January, and you've already got a point. So you had a point from a quarterly return being late, and then you got a point for missing your January deadline, you would have 2 points, so you'd get a £200 penalty at that point. So it's different point system for quarterly returns to the final year return. The next question that's come up, I was just about to say, points last for 2 years. So your point system will be, once a point has gone more than 2 years old, it will fall off. The other point about penalties, it doesn't mean your slate is clear once you pay a penalty. So if you've got 4 points because you haven't done any of your quarterly returns, you've got £200 penalty, they don't disappear. They still carry on for the 2-year period. So if you miss the next one, you automatically get another £200 penalty. So because you've already got 4 and you've got another one and you're still over 4, so therefore you get an instant £200 for the second miss. So I think the whole point about these is initially it looks quite good because they're not charging you when you miss the first return, or in the quarterlies, the second and the third. But if you are constantly missing them, these penalties will add up. You know, if you haven't done any of your quarterly returns for 2 years, then you're going to be at £1,000, I think. They could get quite costly. So that is where MTD is at the moment. I suspect over the next 6 to 12 months, more information will come out from revenue because they haven't finalized it all yet. As I say, and in that period over the next probably 6 months, the software will start to come. Those that well, there are some out there, but there'll be more. And as I said, I think the main point I would say to you all is probably, and I wouldn't do it now because I think there's probably will be better software coming through that might suit some of you. And if you've got one property, I don't think you really want to go for something like a Sage, but and something like a smartphone app will probably be really good for you. If you've got several properties, then something like Xero or Sage might definitely be worthwhile. I think I would wait on software choices if you're not using it at the moment until probably early next year, when there will be quite a few around that will help you decide the one that suits you. And I think the main point in this is it all flows through the software. So you're gonna have to find something that suits you and make sure you use it, which is why I think practicing in the 23 year is not a bad idea, because it's all a bit of a change for us. Look, I've done tax for 30 years. I'm rubbish at doing my own tax return and keeping the records of it, and I do tax. So I think it's all of us getting used to perhaps regularly each month doing our records electronically, so they're there, because otherwise it could be, you could get quite far behind, and it could get quite hard. So I think it's just that we all need to change our sort of way of doing these. So that's, feel free to ask more questions in MTD. I was going to talk a little bit also about some other things on income tax and property rentals. So I think ownership is quite important when you're looking at property. And that's for a number of reasons. Our personal tax system has about 25 bands of different rates. So, you have your personal allowance, you have your basic rate band, the 40% and the 45, but you also have quite a lot of other things that interact. So you have the child benefit rate, you have losing your pension. I could go on, but there is about 25 of them. So where the taxes individuals pay, which band they are, and how much tax you pay will greatly depend about where your total profits sit. And ownership can affect the bands and the overall tax quite dramatically. Rental property works purely on ownership. So if you've got, let's say you've got a husband and wife, and let's say the wife is she's got 50,000 of her income, and she's got 20,000 of property joint with the husband. The husband's got 20, so she's at 70,000 of income and he's at 20. Now you can't just say, oh, I want my husband in that scenario to have 90% of the profit on the property if I own it 50-50. Okay, because it follows the ownership. So in that scenario, what you've got there is you've got the wife having 70,000 total income, the husband having 20, which means she's in 40% and he's not using his full 20% band. So in that scenario, you should look about changing potentially the beneficial ownership of the property. So if the property was owned 90%, say by the husband, 10% by the wife, then she would get 90% of that rental profit and he'd only get 10%. You have to, if you change ownerships and it's not 50-50, or if you buy a property and it's not 50-50, you have to do an actual election which says I own 90% and my husband owns 10%. It's actually a form you have to submit, and if you can only date that 3 months after the submission. So if you bought a property on 1st of January and it was owned 90-10, you need to submit that election to the revenue by 31st March to have those rates apply. Otherwise, they don't apply from when it is. So that's quite an important point, because I think a lot of people don't understand that. Because other types of business, you can play with, in a trading partnership, you can play a little bit with how you share the profit. You can't with property. You have to be quite particular, and it has to follow ownership. That can be beneficial ownership. It doesn't have to be purely. So you could hold it 50-50 at land registry, but have a declaration of trust which says I own it 90-10. And that's quite common. So I think that ownership of the property can be quite important to the overall tax. Normally, it's best to try and do that when you buy a property. You can transfer between spouses without any capital gains, but watch out, if you've got a mortgage on a property, you can have a stamp duty liability on the mortgage, even between spouses, because it's not deemed to be a gift, the mortgage bit. So you have to be a bit careful on transfers, particularly with mortgages, that you don't create liabilities. I think it's always best to try and plan up front how you want to own a property. It's easier, particularly if you've got mortgages. The other, you can also, you've got children over 18, use them in ownership, but again, be careful with that one. There's no CGT exemption if you gift a property to a child. So again, in that scenario, you want to do it when you buy a property. So, if you're thinking, okay, I've got a couple of children, they're over 18, then they're not using their basic rate, or they're at uni and I'm paying part of their fees, and how do I sort that? You could, in buying a property, give them, say, 10% of the property each, and they would have 10% of that profit. But if you owned a property and you just transferred it to them, you could end up with a CGT liability on that transfer. So there are some things you can do about that, but that's a bit complex for this one. But I think look at your ownerships, make sure you're paying the rate at the lowest rate you can. The thing that's getting more common is using companies. I would say with companies, it's only for those that have got a number of properties, because companies are more expensive to run. If you've got a portfolio, or you're building a portfolio of several properties, and companies are really good. The tax rate is generally lower because you're at 19%. Okay, it's going up to 25, but if you're a high rate payer, that's quite a lot lower. You also get full interest relief in a company. As an individual, you only get relief at 20% on interest. And more particularly, it can be really good for inheritance tax planning companies. It's very easy to transfer shares rather than property. But it's not, say, you need a reasonable size of portfolio to want to do that. Also, if your portfolio is owned in an individual name and you want to put it into a company, it can be quite expensive. So the structuring on that, it's more about thinking about it as you go before you buy things, rather than necessarily changing it when you've got them. for companies, but they are something worth thinking about. But I think the main point I would say, make sure you use, particularly between spouses, the basic rate bands properly. Right, I've got other question back on MTD, which I think a lot of people are going to ask. My tax return is completed by an agent, but I won't want to pay him to do quarterly accounts. Will I be able to submit quarterly statements and use them for the annual? Yes, you should be able to do that. There's no reason you shouldn't be able to do that. And that makes some sense, because the quarterly ones, if all you're doing is showing total income and expenses, it shouldn't hopefully be that complicated. So hopefully you can do it and you wouldn't need to pay a professional to do it. But as you say in that one, the end of year, which has all your other income, is obviously more complicated. So using your agent to do that makes some sense. So I think that's a good question. I appreciate my talk about structure and tax was quite quick, but I think it's mainly just to think about it. As I say, on that one, I would say it's the tax can be very different depending on what rates you're on. It's just one of planning. Okay, so any other questions people have on MTD or want to ask just generally on property taxes? Very free to take them.
Just had another one up there, Andrew. Just have one.
Oh yeah. Oh. It's an interesting question, that. I'm not sure I know the answer to that. My husband and I own landlords of property, but we also rent a room to mother using a rent a room allowance. Yeah, okay. And rent a room on Airbnb. Right. So the rent a room allowance, will that be included? Ooh, I don't know off my head. You sort of think you say it shouldn't be because it's not going to be taxable. The Airbnb would be. I'm sure that will be in there unless it's yeah, you're doing it under rent a room. I think that is a question. I'm not seeing that in any of the guidance at the moment. It may be hidden in some detail. I'm sure that will get clarified before it comes, but I'm afraid I can't answer it off my head on that one.
Okay,
yeah, but it's a very good question.
I've got a question, Andrew. That's okay. Just something that's happened with a landlord that's asked me recently. So they've refurbed the bathroom at their rental property. So it did previously have a bath, toilet, sink. They've replaced the bath with a double walk-in shower cubicle.
Yeah, okay.
So you're guessing the question is, so can they claim the relief because they haven't replaced it like for like, they've improved it in their
Yeah, and it's an interesting one, the improved one, because it used to be, so the classic was this, and this is going back a bit in time, was you had a single glazed window and you replaced it with a new, and it was a wooden one, it's old, and you replaced it with a double glazed PVC one, modern standard. Now, the revenue used to in the old days argue that was an improvement and you can claim it. However, they have they accept nowadays that if you are replacing something with a modern equivalent, then that's fine. So in that example of replacing the my example of single glazed wooden with a double glazed PVC, that would be fine nowadays. Your interesting one gets into your bathroom. So you if you replace like for like and it's not improvement, it wouldn't be a problem. When the question mark, and it's a debatable question mark, is it an improvement bringing a shower or a bath? Well, a lot of people will say yes, some people say no. So it's probably borderline a bit, that one. And you can get quite a few that get to this sort of borderline point. I would, so it's one in that, if they, and I assume in this case as well, they've been renting this property out for some time. And that does also have a bit of a difference when you're looking at repairs. So in the case where they've had a bathroom for a long time within it, they've been renting out for a long time, they're replacing it with a modern one within it, I don't think they should have an issue with it.
Okay.
Now, where you can get issues is if, let's say you buy a really rundown property that is not lettable. So if you have that scenario, so you buy a property, it needs a lot of work on it because, and it's not lettable, you know, you can't let it in its current state, and you spend a lot of money on what would in a lot of cases be repairs, but you're improving it, then actually that element of that bit would be disallowable. So because you've got a property that's not in a fit state to be let in the first place. The revenue argument on that is your capital cost was discounted in the first place because it wasn't usable, and therefore it's capital. Conversely, though, if you bought one that had been previously let out and was let out and you bought it and did some more work on it, then that still should be okay because it was lettable in the first place. But if you
isn't always the best option, then.
Sorry?
Do a wrapper isn't always the best option.
Well, it's a debate point, isn't it? Because you might hopefully make more on your value than you did in the lost tax relief. Yeah, you'd always get that as against the capital gain in the end anyway.
Yeah.
So if it's an improvement, you do get it against capital gain. It's just not against your income. So yeah, no, repairs and improvements are always a slightly interesting one. And there's a grey line which is always quite debatable.
Yeah. So that landlord had just bought the property and decided to change the bathroom because he didn't like it. That's when we start going, you probably can't claim that.
I think some of that might depend on the state of it in the first place.
Okay. And how would you prove? Would you have to prove that? And how? I know I'm getting deep now, but
it would depend a little bit, probably. It's quite, if you're going to spend a bit of money on it, I think it's worthwhile making sure you've got the detail behind it. So you've got the invoices behind it, which itemize out what you're spending on. It's quite often worth taking pictures and things. So if you get an inspector that gets quite detailed into it, you've got evidence to prove your case.
Yeah.
Okay. So yeah, if in your scenario the bathroom was quite usable in the first place and you got pictures showing it's quite usable in the first place, then that will help you.
Yeah.
So evidence is quite useful normally.
Yeah, and you would submit that. Okay. Yeah.
Well, if you got queried, you would, but otherwise.
Yeah. So only if you got queried, you need to submit that.
Yeah, no, absolutely. You wouldn't need to submit photos with your return or anything. It's only if you've got questions from the revenue about your repairs deduction.
Yeah. Yeah.
Yeah.
So I was on a webinar recently just about tax. So I'm going to pick your brain on this one as well. And it was for agents about advising what we should be advising. And the advisor did say, and this is where it comes in the like for like, if you're replacing taps, you should replace taps like for like, not improve them. So if I had sort of a standard mixer tap now, I couldn't go out for my property and buy this all singing, all dancing hot water tap. Obviously, I wouldn't be able to claim relief on that because that's not like for like.
Yeah, it's this is where it gets slightly interesting because I think some of those might fall into the more norm of modern sort of equipment now. So a bit more like your double glazing bit. So your mixer taps are now much more common than your individuals you used to be.
Yeah.
So people now when they're buying the bathroom tend to have mixer taps. So I think there's an argument there that actually going to single to a mixer, all you're using is a modern equivalent.
What was available to you.
Yeah, and it wasn't before.
Steve, I can see you've asked a question. That's for me. Can Complete prepare my quarterly returns to me from their monthly statements? At this stage, obviously, software-wise, not 100% sure. But at the moment, what we can do with our system is we can send you your end-of-year tax statements, your income and expenditure, which you can then provide to your accountant or use for your tax return. I imagine letting software systems are going to allow us to do quarterly ones for landlords, but we're not going to be able to submit that for you. Andrew's nodding his head. you're still going to have to submit that yourself, but we'll be able to provide you with the information on your income and expenditure for you to upload onto whatever software you have. But I can't see agents being able to submit them for you, unless Andrew's going to tell me different.
Well, you would, I think the problem with that is that you would have to do two things. One, you would have to have the commercial tax software to make it work.
Yeah.
So the accounting software that's compatible, which is not the same as your rental, your agent software that you've got at the moment. Secondly, to submit it for yourself, you would have to be the tax agent for that client.
Yeah.
So I think that's the problem with that, because agents can submit electronically with the right software, but they have to be the agent. Whether they adapt that to say, because at the moment, really, you can only have one tax agent. It may be they look at that and decide, okay, we could have a different agent for quarterlies, but I suspect they'll find that's quite difficult for them from security, because obviously they are quite paranoid on security, quite rightly so, because they hold a lot of confidential information. So quite often in that sort of scenario, I don't think they would be that keen on having more than one agent.
Yeah. So yes, I think you just sit there for a fee for the convenience of overseas landlords.
Yeah,
I completely get your point. I completely understand that. It's just, again, it's the legalities and whether we're allowed to do that. We can definitely provide you all the information you're going to need to submit your quarterly returns. I'm not sure whether we're going to be able to actually physically do it for you, but watch this space, I think, is more of a term on that.
That's a good question.
One for you, Andrew, is one that I had in my mind recently with all the EPC regs.
So what will you have to do on that? I mean, you're going to have to do...
It's going to have to go to C, so it could be boilers, double glazing, loft insulation, floor insulation, wall insulation. It's never-ending list depending on the current rating of the property.
Yeah, so a lot of those, so boiler replacing, you'd be replacing the existing boiler with a modern boiler, wouldn't you?
Or they haven't got a boiler, is probably more likely, as in it's probably electric heating and have to upgrade to gas central to make it meet the regulations.
Yeah, okay.
That's where the query is probably coming, because you're definitely not doing like for like. You're going from electric night storage to having to put gas central heating to get your property up to an acceptable rating.
Yeah, okay.
The cap of expenditure on that's 10 grand, which is probably why people are asking whether they can claim that back.
Okay.
Because that's quite a lot of money to have to spend.
Just seeing if it's got any guidance at that point. You'll be going from gas to a gas boiler. So
are you Cala gas at the moment then, or are you just gas fired range? Adrian would be my question. How are you heated at the moment? I suppose if the government are bringing in all these changes to where property standards have got to be, it would be nice if it was considered tax deductible.
Yeah, I think a lot of these might be a bit specific depending on what you're having to do.
Yeah.
But you can't actually. It looks like you've got a gas boiler already.
A gas boiler, so you're replacing.
So I think you could replace a gas boiler with a modern gas boiler. I don't think you should have an issue with that one. I would certainly think you've got a claim on that.
Yeah.
Because you are replacing sort of like for like. It's just a modern equivalent. So.
But where we're doing electric heating to gas, we might have an issue.
Yeah, that might be more of a problem on that. It's an interesting one, because I was just looking at some. Yeah, so and when you're looking at improvement, one of the questions actually look at is, as a result of the work, can more be done with the asset than it could be before? Now, actually, in your gas boiler thing, it can't. It's like it was heating the house before; it's still heating the house. So, so I think that's that should be fine. So, and I think a lot of the things that you're doing there, insulation and etc., are not really an improvement within that. They're just part of the repairs of the fabric. So a lot of that I think should be okay, because a lot of those things aren't going to do something different.
Double
They're
glazing
slightly
was
better.
going to be okay earlier, didn't you? Double glazing.
Yeah. And actually, in the scenario where you've had a house that you've been let out 30 years, you will quite often have, every 10 years or so, some quite big expenditure on those properties. And that's not unusual.
Hopefully, yes, is the answer.
So I think a lot of the expenditure you have to do on these upgrading and those things would generally be repairs. But you just have to look a little bit at each one as to what you're spending on it. But certainly, I think that one looks fine to me, gas to gas.
Yeah, just if you're doing a bigger one, it might be interesting. Interesting. Has anybody else got any further questions or quizzes for Andrew? We said this is going to be an interesting one, didn't we? So perfect. And the other one that I've had from a landlord as well recently, obviously agents' monthly management fees they're paying at the moment. They're now also paying an insurance premium for rent protection.
Yeah, okay.
Can they take that as tax protection relief?
Yeah, the rent protection, yeah, that's fine. But if they pay out on it, then that's income will be included. So, so it's what you've got there is you've got an insurance premium to protect your income.
Yeah.
So it's a business expense. What you have to remember though is if it pays out and pays you lost rent, that will be taxable rent.
Yeah.
Okay. So you get deduction on it, but you will then have to treat any payment under the policy as income as well.
Yeah. Perfect. Right, I'm going to do a final call for questions before we let everybody go and relax for the evening. We'll take a glass of wine, but it's Tuesday. Is that a bit early? Early in the week.
Day.
This is the evening. It's not 10 o'clock in the morning.
That's true.
I think we're all quite pleased to have some rain now as well, aren't we? After the past few weeks of drought and desert temperatures, it's felt like. So, but I can't see any more coming in, Andrew. So I think you have answered everybody's queries. Oh, you've had Mr. Browne was an excellent and clear speaker. Thank you.
Thank you, Adrian. That's very kind of you.
It'd just be very nice to you. So thank you everybody for attending this evening. I said we will follow up in the next couple of days with a recording of the meeting. I'll also do a link for the web page that Andrew mentioned earlier with the approved software that's on there at the moment. Like Andrew said, some of the software, there is software being developed, so it may not be worth jumping on too hard with anything just yet. It might be worth waiting and holding your horses, but at least you'll have that link to where that is. And I'll also put on there Andrew's contact details, so if you do need any further help with your tax liabilities, you can contact him, and I'm sure he'll be more than happy to help you, or one of his team can as well. So thank you very much for your time this evening, Andrew.
Pleasure, and
very
thank you
helpful.
all.
I think we've learned something.
Have a nice evening, everybody.
Thank you, and thank you for being quizzed.
Yeah,
that's brilliant.
Bye.
So that's great. All right, lovely. So we're going to end the meeting now, and we'll catch you really soon. Thank you. Thanks, Andrew.
Thanks so much. Bye.
Bye.